For the last 80 years, the global financial system has rested on one unshakable pillar, the United States dollar. It is the sun around which every other economy orbits. It is the currency of trade, of debt, and of geopolitical power. But while the world has been obsessed with the rise of China, the debts of Europe, or the policies of the Federal Reserve, a massive structural fracture has opened up in the unlikeliest of places. It isn't coming from an enemy. It is coming from America's strongest ally in the Pacific. It is coming from the quiet giant of the global economy, Japan. For decades, Japan has been the silent partner, financing the American dream. They bought our debt when no one else would. They pumped liquidity into our stock markets. They anchored the global flow of capital, but that era is ending. Right now, two massive financial forces are colliding in Tokyo, a historic sell-off of U.S. government debt and the collapse of the greatest free money trade in history. This isn't just a market correction, it is a reversal of the tides. If you want to understand why mortgage rates in America might stay high or why the dollar's dominance is suddenly under siege, you don't need to look at Washington, D.C. You need to look at the Bank of Japan. Because the reservoir that has watered the American economy for a generation is finally running dry. To understand the magnitude of this threat, we first have to look at the scale of the relationship. Japan is the largest foreign holder of U.S. treasuries in the world. As of right now, they hold over $1 trillion in U.S. government bonds. Think of U.S. treasuries as the credit card bill of the United States. For years, Japan has been happily paying off a massive chunk of that bill. Why? Because Japan is an export powerhouse. They sell us cars, electronics, and machinery. They receive U.S. dollars in return, and instead of letting those dollars sit idle, they reinvest them back into safe, reliable U.S. debt. It was a perfect, symbiotic cycle. America got cheap goods and cheap loans. Japan got a stable place to store its wealth. But that cycle is breaking. Japan is currently facing a currency nightmare. The yen has hit historic lows against the dollar. At the same time, their national debt is terrifying, nearly 250% of their GDP. To put that in perspective, that is significantly worse than the U.S. debt ratio. The Bank of Japan is backed into a corner. To stop the yen from becoming worthless, to protect the purchasing power of their people, they need cash. Specifically, they need U.S. dollars to buy back their own currency and stabilize the markets. So, where do they get that cash? They have to sell the family silver. They have to sell those U.S. treasuries. This is the first prong of the crisis. If Japan begins to structurally unload billions of dollars in U.S. bonds to save the yen and cover their rising interest costs, the market for U.S. debt gets flooded. It is basic economics. When the supply of bonds goes up, the price goes down. And when bond prices go down, yields or interest rates go up. If Japan stops buying, or worse, starts aggressively selling, U.S. interest rates could face massive upward pressure, regardless of what the Federal Reserve wants to do. That means higher borrowing costs for the U.S. government, and eventually, higher rates for American homebuyers and businesses. However, simply selling bonds is just the tip of the iceberg. The real danger is something much more complex, much more volatile, and much more deeply embedded in the global financial system. It is the collapse of the yen carry trade. In the financial world, there has been a cheat code used by hedge funds and institutional investors for over a decade. Here's how it worked. For years, Japan kept its interest rates at zero or even negative. It was effectively free to borrow money there. Meanwhile, in the United States, interest rates were higher, especially in recent years, where they hovered around 5%. So, investors did the logical thing. They borrowed billions of yen for free. They converted that yen into U.S. dollars. And then they invested those dollars in American assets that paid a yield like U.S. treasuries, corporate bonds, or the S&P 500. They pocketed the difference between the 0% they paid in Japan and the 5% they earned in America. It was virtually risk-free profit. This trade created a massive, artificial demand for the U.S. dollar. Investors needed dollars to make the trade work. It pushed U.S. asset prices up and kept the dollar strong. But remember, this entire machine only works if Japan's interest rates stay at zero. And that is exactly what is changing. The Bank of Japan has started raising rates. The era of free money is officially over, and suddenly, that risk-free trade has become a trap. This brings us to the Great Unwind. As Japan raises rates, the cost to borrow yen goes up, eating into those profit margins. But even more critically, as rates rise, the yen starts to strengthen against the dollar. If you are an investor who borrowed 1 million yen when it was cheap, and now the yen gets stronger, you suddenly owe effectively more money in dollar terms to pay back that loan. Panic sets in. Investors realize they are losing money on the currency exchange. They have to get out. But how do you close a carry trade? You have to do the reverse of what you started with. You sell your US assets, your stocks, your bonds. You take those dollars, you convert them back to yen, and you pay off the loan. This creates a dangerous feedback loop. Selling US assets lowers their price. Selling dollars to buy yen drives the dollar down and the yen up. A stronger yen causes even more investors to panic and unwind their trades. It acts like a margin call on a global scale. We aren't talking about a few $billion here. We are talking about massive flows of global liquidity that have been propping up American markets for a decade, suddenly heading for the exit door. I want you to visualize this dynamic with a specific image. Imagine the U.S. financial system as a vast agricultural field. For years, this field has remained lush and green, even during droughts, because it was fed by a massive reservoir, Japanese capital. This reservoir was constantly pumping water liquidity into the U.S. It kept bond yields down. It kept stock prices up. It was a reliable, steady stream that American policymakers took for granted. But the structural changes we are seeing now, the selling of treasuries and the death of the carry trade, are not just shutting off the valve, they are reversing the pump. Japan isn't just stopping the flow of money into America. They are actively sucking capital back to Japan to deal with their domestic crisis. The water is leaving the field. And when liquidity leaves a market, volatility enters. This phenomenon creates a structural headwind. It means that for the next few years, the US dollar is swimming upstream. The artificial support that kept the dollar strong and borrowing costs low is vanishing. So, what does this actually mean for the United States economy? Is the dollar going to collapse tomorrow? No. The US dollar is still the world's reserve currency, and it has incredible inertia. But we need to be realistic about the consequences. We are looking at a higher for longer reality, not just because of the Fed, but because of Japan. First, bond yields. With Japan selling, there are fewer buyers for U.S. debt. To attract new buyers, the U.S. government will have to offer higher interest rates. This acts as a floor for mortgage rates and business loans. Even if the Fed cuts rates, if the bond market is flooded with supply from Japan, rates might not come down as much as we hope. Second, stock market volatility. As the carry trade unwinds, billions in liquidity exit the U.S. stock market. We have already seen flashes of this volatility, but it could become the new normal. The buy-the-dip mentality was funded by cheap yen. That funding is gone. Third, structural dollar weakness. While a weaker dollar might help U.S. exports, it makes imports more expensive. That means inflation could be stickier than the Fed predicts. We could be entering a period where goods simply cost more because the currency used to buy them has lost a major source of its strength. The irony of history is sharp here. In the 1,980 seconds, America feared Japan would buy up the United States. We feared their economic dominance. Today, the fear shouldn't be that they are buying, but that they are selling. The global economy is a delicate ecosystem. We often think of the U.S. as an island, immune to the storms overseas. But the great reversal of Japanese capital proves that in finance, there are no islands. The Japanese reservoir is draining. The pipes are reversing flow. And the U.S. dollar is about to learn how to swim without its oldest life vest. Keep your eyes on the yen. Keep your eyes on the 10-year Treasury yield. These are the boring numbers that determine the fate of empires. The tectonic plates of global finance are shifting, and the tremors are just beginning.